Hello. Many of you had requested for an analysis of the Friday equity market sell-off worldwide and what its impact can be on India. So I thought I'll do a quick short video. So first of all, what happened on Friday? Well, Friday actually three things happened in decreasing order of importance. First is there's a company called Broadcom, which is an AI-related company. It published its results. Now the results were not disappointing. They were actually fantastic, but they beat the expectations of the thing in on the downward side, which means they underperformed. So they were projecting a 17 billion chip sales, but they delivered 16 billion. Okay, and they said that by next year their target would be to do 100 billion. They didn't change it to upwards from 100 billion. They kept it the same. And the third thing is that they sell to Google, that is the Alphabet company, right? They have a 96% share now, but there's another company called MediaTek which is also competing. So this 96% share is expected to go to 80% next year and 65% the following year. And so they said the stock is corrected. So the company must be thinking, what else can we do? I mean, you can't keep raising expectations, raising thing every time. But that's the reality, because even after this correction, Broadcom's valuation is still a PE of 37x. But like I said, the expectations from AI are incredible. And because of that, any slight disappointment from perceived expansion versus lesser than that leads to a sharp sell-off. And that's hit not only Broadcom, but it hit the entire semiconductor pack. TSMC in Taiwan, Samsung, then other companies in Korea, all of them got hammered yesterday, and naturally the Nasdaq fell about 4%, right? So this was a tech AI led sell-off, the primary reason. The second reason in the US was the jobs data. Market was expecting 85 to 88,000 jobs to be created, fresh jobs, but it came into 1,77,000, double of that expected. So what in the market then? You should be happy about good GDP growth resulting from this. No, the thing is that a Fed rate cut now disappears for the rest of the year, because if inflation is already rising because of the war, if on top of it the employment is also rising, then Fed in fact will look at a rate hike and not a rate cut, and the probability of a rate hike by the end of the year is now increasing gradually. So that gave a shock to the equity markets. Equity markets don't like rate hikes, they like only rate cuts. The third aspect which hit the markets was on the war front, where there was expectation of easing, some proposal, counter proposal, some discussion. Then Mr. Netanyahu gives an interview. He says, US and us are ready to attack if anything goes false. So again, that led to a bit of tension. So there was a least of the reasons, however. So these three led to that big market sell-off, right? Now, what is likely to be the impact? Well, Gift Nifty is showing a strong down. So there is likely to be a gap down opening on Monday. Why? Because the US interest rates have crossed again 4.5%. So in the question of an interest rate hike happens there, so money tends to flow into US and away from emerging markets. So yesterday, along with the Nasdaq, you have the Korean market and the Tokyo market and the markets, all of the markets corrected, right? So this flow of money away from emerging markets will have an impact on India. That's number one. Number two is that even with the use, there's a slightly risk off in terms of the fact that it moved into defensive. So stocks like Colgate, Johnson & Johnson, Coca-Cola, they all rose yesterday, even in this fall. So it seems like it's a distinct sell-off from the AI part. So from an India perspective, while there'll be a gap down, there are 2-3 things which could help the market recover during the day, or at least in a day or two, which are that, first of all, is that if there is a genuine AI risk off, right, then India is the classic AI hedge, because we are not producers of chips, right? But we are users of AI hardware, because through the data centers to software applications that we use for AI consulting, we are the downstream users or consumption side of AI, but not the producers. So any move away from AI might benefit India, and some FIs could take a call on that. Second aspect here is that the move of RBI to get money into the government securities, opening up 15, 20 and 30-year bonds, also 15, 20 and 40-year bonds also for foreigners, the removal of tax exemptions, which means that the outlook for the currency, which was earlier looking like a year down the road or something could go to 97 to 100, will mean, because about 40 to 75 billion dollars. I saw various reports in terms of how much money can come into G6, because not only on the existing 10-year G6, They have now expanded it to a much wider thing, and they have removed withholding tax and capital gains tax. So estimate is that over 40 to 75% over a medium term can come into Indian G-Stocks. So this will help those interest rates come down, but that's different. But currency will not weaken as much, and that's a key factor which FIs look at when they put money into India, so that the expected currency weakening is going to be much less than before. Could be a positive trigger which may happen later in the day tomorrow, or maybe later in the course of the week or the month, but it's a positive for that, and hence this is a positive for equity flows, right? So that's where I'm coming from. The other thing is that overall, if you see the situation, right, the Indian valuations have now corrected significantly, because after yesterday's correction also, trailing P is about 20x. Our long-term averages are also around 20x. So we are no longer an overvalued market from an FII perspective. So any move, and if you look at it, a lot of the FII outflows from India have been equally, I would say, from active fund managers who are underweighting India, but passively, the share in the index from August 2024 was 20%. It's come down below 12, 11.94. Why do I point this out? It's this natural outflow. So now yesterday's correction, what happens, I'll tell you. A single company like TSMC, its share in the MSCI Emerging Market Ticket is 14%, more than a country's share. Similarly, if you add the three or top semiconductor companies in Asia, they are 24% of the index. So any correction and readjustment of the index could lead to more passive flows into India, and that's unpredictable, but it's a potential that passive flows, because they readjust flows. And also, if you see, I hear that a lot of FI fund managers also constrained by a rule which is very similar to the SEBI rule here, that is 10% in a single stock. So if a TSMC is 14% of the index, a lot of fund managers says, no, I don't want to take that much risk. The index may have it, but I want to weight it down. So a combination of these factors from a valuation perspective will also be supportive to Indian equities from an FI flows. Hard to predict any of this, but I was just laying out the positives and the negatives, and let's hope that the positives come in and dominate, at least in the later half of the day or later in the coming days and weeks, right? So that's my quick take on this Friday sell-off and its implications. Hope you like it.